Hello everyone. In previous videos, we have discussed the derivation of the Treynor-Black model. In this one, we are going to use Excel to implement it. You are going to recall that the Treynor-Black model seeks to construct an active portfolio of securities, and we are hoping that a combination of the active and passive portfolios will give us a better Sharpe ratio than the passive portfolio alone. Well, what is the passive portfolio? The passive portfolio tracks the market and is supposed to be well diversified. We can use S&P 500 index or any other market index as a proxy for our passive portfolio. In this demonstration, we are using the S&P 500 index. The active portfolio would comprise of some securities that have been selected from security analysis, and hopefully they can provide us with some positive alpha, which of course, as you will remember, is going to come at the cost of introducing some residual variance, because we are moving away from the well diversified position in the passive portfolio. In this demonstration, I have selected 5 out of the 26 companies from Warren Buffett's portfolio as on 14th February 2012, and these 5 securities or 5 stocks are going to be a part of our active portfolio. Because this is just a demonstration, I have used only a few data points, and the results that we are going to see should not be taken as any investment advice. The data comprise of monthly stock prices from February 2011 to January 2012 for 5 stocks in the active portfolio. Number 1, Coca-Cola. Number 2, Wells Fargo. Number 3, American Express. Number 4, Procter & Gamble. And number 5, Kraft Foods Incorporation. We also have the S&P 500 monthly closing values, which have been used to compute the return on the passive portfolio. In order to compute the risk premium or the excess return, which you see here in this row, for all the 5 stocks that comprise the active portfolio, and also for the S&P 500 index, which is our passive portfolio, we have to use an estimate of the risk-free rate. I have used 1-month T-bill rates during this time period, which has been subtracted from the raw returns for these securities here, and also the raw returns for the index portfolio here. The results are provided in this row. To save some time, I also have run a few regressions, which have given me the estimates that would be used as inputs for the Treynor-Black model. These estimates include the alphas, betas, the standard deviations of the residual term, and the standard deviations of the risk premium, and that has been done for all 5 stocks in the active portfolio. The results are here in this panel here. The alpha of the index portfolio or the passive portfolio is 0. We talked about that in the previous videos, so a value of 0 has been used here. Also, we know that the standard deviation of the residual term for the index portfolio or the market is 0, so we have a 0 value here too. Beta of the market or the index portfolio is 1 by default, so that has been entered here as well. For implementing the Treynor-Black model, I have used the template, this one here, and this template has been extracted from the 9th edition of the book on investments by Bodie, Kane and Marcus. We are going to fill this template as we go along. So let us begin by looking at the first thing that we need to do. We need to first of all establish the initial weights on the individual securities that comprise the active portfolio. In order to do that, we need 2 data estimates. 1, the alpha of the security, which is in the numerator here, and 2, the variance, the residual variance rather, which is in the denominator here. We already have the alpha estimates in this row. What we need to figure out in order to proceed is the residual variance. We also have the standard deviation of the residual term. So the residual variance would simply be a square of these numbers. So let us do that first. In this row, let us do it for Coca-Cola in this cell first, and whatever we do for Coca-Cola, we can extend it to the other securities as well by dragging the formula across. So for Coca-Cola, this is the residual variance, cell B5. The residual standard deviation, cell B5, and we are going to square it up. Once we have done that, we can drag this across for all other securities in the active portfolio. So we now have the residual variance of all the stocks in the active portfolio, and we can now compute the initial weights for all the stocks in the active portfolio in this row here. Let us do it for Coca-Cola in this cell, and like we did before, we can drag the formula across for all other securities in the active portfolio. So what do we need to do? We need to divide the alpha of Coca-Cola here with the residual variance of Coca-Cola, which is here. And we can drag the result across for all securities that comprise the active portfolio. Once that is done, we can move to find the final weights for all the securities that comprise the active portfolio. The formula for doing that is here. You will notice that the numerator in this formula here, this one, alpha I over variance, residual variance of I, is this row here. And we need to divide this item by the sum of all alpha i's over residual variances. So let us calculate the sum first. Let's do that in this cell. The sum of all these items. Well, looks like there is some problem here. Let's do that again here because I forgot to write the sum. Sum of all these values. Alright, so now we are ready to find the final weights in the active portfolio for individual securities. Let's do that for Coca-Cola in this cell. What we need to do is to pick up this number here, and we need to divide this number by the sum of all the numbers in this row, which is 42.31772 and appears in cell C12. You will also observe that this cell reference C12 is going to be used for all these cells here as well. So we don't want this cell reference to change. We can easily do that by inserting a $sign on either side of letter C, and then we can drag the formula across to the right for all the securities in the active portfolio. We can run a quick check to see if these weights are okay, because we know that the sum of all weights should be equal to 1. In fact, the purpose of doing what we have done in this row, that is dividing all these numbers here by the sum of all these numbers, it has been done to make sure that the weights are scaled to 1. Let's check that if this is the case. Sum of all these numbers, which is in fact 1, and so everything seems to be in proper order. Now we can proceed further. In the template, the next item that we see is the alpha of the active portfolio, which we can calculate in this cell, but the alpha of the active portfolio is going to depend on the alpha of the individual securities that comprise the active portfolio. Well, this is the formula that we have. This one here, alpha of the active portfolio. What do we see? We see that we need to multiply the weight on each security with its alpha, and once we have done it for all the securities, we need to add all the items. So let us do that. Let's do that for Coca-Cola here first. The weight on Coca-Cola is this, times the alpha on Coca-Cola is this. And we can do this for all other securities as well in the active portfolio, which means that the alpha of the active portfolio is going to be simply the sum of these numbers. So now we have the alpha of the active portfolio. We also need to have the variance of the active portfolio so that we can move on to find the initial weight in the active portfolio. This is the initial weight for the active portfolio, and you will observe that we need this item here, variance, the residual variance of the active portfolio. So let us first of all figure that out. How do we do that? Well, here is a formula for finding out the residual variance for the active portfolio. What are we doing? We are squaring up the weight for each security and then multiplying that squared weight with its respective residual variance. And we are doing this for all securities, and then we are adding all the items up. So let us do it for Coca-Cola here, and we can extend the analysis to the other 4 securities too. So what do we need to do? We need to pick up the weight, which is here. We need to square it up, and then we need to multiply that by the residual variance, which is here. Hit enter, and we have this 0.00004. We can drag it across for all other securities in the active portfolio. And then to find the residual variance for the active portfolio, we can simply sum up all these numbers. So 0.00045 is our residual variance for the active portfolio. Now let us find the initial weight on the active portfolio in this cell, the formula for which is here. Let us implement this formula. What do we have to write in the numerator? We need to write the alpha of the active portfolio, which is this, and we need to divide this alpha by the residual variance of the active portfolio, which is this, close brackets. And then in the denominator, what do we need to write? We need to write the risk premium on the market, which is this here, and we need to divide this risk premium by the variance of the market. Do we have the variance of the market? Well, we have the standard deviation of the market here in this cell, and we can square it up. So let us select this cell reference and square it, and let us not forget the brackets, and then hit enter. So this is our initial weighting on the active portfolio. Seems pretty huge, but this is going to be adjusted for the actual beta of the active portfolio, and it's going to come down. We are going to see that shortly. In this cell here, we want to figure out the final weight that we need to place on the active portfolio. The formula for doing that is here. What you see in the formula is that we need an estimate for the beta of the active portfolio. So the first thing that we need to do is to figure out the beta of the active portfolio. We are going to do that here. In this cell, we are going to find the beta for Coca-Cola adjusted for weights. In this cell, we are going to do that for Wells Fargo. In this cell, for American Express, and so on for all the securities. How are we doing that? We are doing that by using this formula here. We are multiplying the weight on each security with its beta, and when we have done it for all securities, we are simply adding them up, and that would give us the beta for the active portfolio. So let us do it here. For Coca-Cola, this is the weight, and we are going to multiply this with the beta of Coca-Cola, which is this. Hit enter. We see 0.00585, and we can drag this for all the other securities in the active portfolio. The sum of all these betas is going to be the beta of the active portfolio. So let's take the sum. So this is our beta for the active portfolio, 0.25578. Now we are ready to find the final weight on the active portfolio, for which we can use this formula here. Let us implement it in this cell. What we have on the numerator is the initial weight on the active portfolio, which is this cell reference, and we need to divide this by 1 plus 1 minus beta of A, which is this, and multiplied by the initial weight on the active portfolio, which is this. Let's close the bracket and hit enter. So this is our weight on the active portfolio, 1.34672, which also means that the weight on the passive portfolio is going to be equal to 1 minus this value here, minus 0.34672. What we observe here is that the Treynor-Black model is essentially giving us a long short position. It is telling us that we should go short in the passive portfolio to this extent, and we should go long in the active portfolio to this extent. 134.672% of our money should go to the active portfolio by selling the passive portfolio short 34%. Alright, let us see what we need to do next. We can also figure out the beta for the complete portfolio. How do we do that? We know that the weight on the passive portfolio is equal to this. We can multiply this weight by the beta of the market, which is 1, and we can add on to it the weight of the active portfolio times the beta of the active portfolio, which is this. So here we have the beta of our complete portfolio, almost 0, indicating to us that there is going to be no systematic risk here, which is pretty good. Let us also now figure out the risk premiums, because eventually we want to find out the Sharpe ratio, and the Sharpe ratio is nothing but risk premium divided by the standard deviation. So we are going to have to figure out the risk premium for our passive portfolio, active portfolio, and the complete portfolio, and then we need to figure out the standard deviation for all these three portfolios, so that then we can calculate the Sharpe ratio to compare the performance. So the risk premium for the passive portfolio is already here, so we can use the same cell reference, which is this, cell G2. So this is our risk premium for the passive portfolio. Let us now find the risk premium for the active portfolio by using the single index model. What does the single index model tell us? It tells us that the risk premium of any security or any portfolio is simply equal to its alpha. So let us see where is the alpha of the active portfolio. Here is the alpha, and then plus beta of the active portfolio, which is this here, times the risk premium on the market, which is this in this cell here. Hit enter, and we have the risk premium for our active portfolio. Let us also find the risk premiums for our individual securities. In this cell, we are going to do that for Coca-Cola. We already know the weight on Coca-Cola, which is this. We can multiply the weight by the risk premium of Coca-Cola, which is here. Hit enter, and we have the risk premium on Coca-Cola here, 0.00187. We can do that for the remaining securities in our active portfolio. Alright, let us now figure out the risk premium for the complete portfolio, which is going to be fairly simple. Well, we know the weights already on our passive portfolio and the active portfolio. So what we are going to do is to pick up the weight on the passive portfolio from here and multiply that by the risk premium on the passive portfolio, and we are going to add on to it the weight on the active portfolio multiplied by the risk premium for the active portfolio. So we have 0.02544 as the risk premium on the active portfolio. We are already seeing an improvement, aren't we? The risk premium for the market is negative. The risk premium for the active portfolio is positive 1.88%, and the risk premium for the complete portfolio is even better, 2.544%. But this improvement has to be looked at in relation to the standard deviation. So we are going to write our standard deviations here in this row. First of all, the standard deviation for the passive portfolio, we already know that. It's here in this cell, G3. So we are going to use the same cell reference. So this is the standard deviation for our passive portfolio. Let us now figure out the standard deviation for the active and complete portfolios. The active portfolio first. We are going to use our single index model definition to calculate the standard deviation. How do we do that? We need to write inside this bracket beta squared for the active portfolio. Well, this is the beta of the active portfolio. We are going to square it up. And we need to multiply this beta squared by the variance of the passive portfolios, which is this here. Well, I did something wrong. Okay. I need to put a multiplication sign. Alright, so this is the standard deviation of our passive portfolio. We are going to square it up to get the variance. So what we have written so far is beta squared times variance of the passive portfolio, or variance of M. To this we need to add the residual variance of the active portfolio, which is this here in this cell. So we are using this cell reference. Close the bracket, and if we leave it here, we will have the estimate of the variance. But because we need the standard deviation, we are going to raise this to the power of half. Hit enter, and we should have the standard deviation of the active portfolio, 0.02453. Let us do the same thing for the complete portfolio as well. So we have beta squared of the complete portfolio, which is this. Square it up, multiply it by the variance of M. Well, this is the standard deviation, so we are squaring this up. Plus, we need to enter the residual variance. Well, we know that there is no residual variance in case of the passive portfolio because the standard deviation of the residual is 0. So all the residual variance that there is coming from the active portfolio, and this is that residual variance. But we can't use this number because we are not investing our entire money in the active portfolio. This is the amount of money that is going to, this is the proportion allocated to the active portfolio. So we are going to adjust this residual variance accordingly. So we are going to say here the weight on the active portfolio multiplied by the residual variance of the active portfolio. Close brackets and raise this to the power of 0.5 to get the standard deviation. So this is our standard deviation for the complete portfolio, 0.02452. We can now very quickly find the Sharpe ratio for each of these portfolios and see if there is any improvement over and above the passive portfolio. The Sharpe ratio is the risk premium divided by the standard deviation. So we see a negative Sharpe ratio here, which is not good, but that was expected because the risk premium was negative. In this cell, let us do it for the active portfolio. This is our risk premium divided by the standard deviation here. Well, we see an improvement for the active portfolio. We are going into the green area, positive 0.76, which is pretty nice. Let us see what happens with the complete portfolio when we combine the passive and active parts together. Well, this is the risk premium, and let's divide it by the standard deviation. And this looks even better. 1.03750 is the Sharpe ratio for the complete portfolio. So what we are seeing basically is that even though the risk premium and Sharpe ratio for the passive portfolio is negative, the active portfolio is adding value by increasing both. You might have observed, and I guess I mentioned that before, that Treynor-Black model basically gives us a long short position. In this demonstration, we are shorting the passive portfolio and going long in the active one. Though it is not the case in this demonstration, many times the Treynor-Black model suggests taking large short positions, which may not seem realistic at times. Well, at least not for a small portfolio manager. Only the big fish like hedge funds and mutual funds may be in a position to take very huge short positions. So this is one problem with the Treynor-Black model. You will also remember that this model uses the mean variance criterion, which of course has its own statistical problems. For example, in this demonstration, though I have not shown it to you, most returns were slightly negatively skewed, and the kurtosis was a little negative as well for many returns. We know from before that the standard deviation underestimates the risk when skewness is negative. So the results that we see here should be interpreted with some wisdom that goes beyond numbers. We should also keep in mind that the results are very sensitive to our estimates of expected returns. What I have done is that I've used historical returns in this demonstration. Somebody else could have used the CAPM returns, while others would like to incorporate their views about returns too. Views are generally forward-looking, and when we incorporate them into the picture, they may or may not endorse the historical trend. Black and Litterman in their paper in 1992 have shown that investor views are important and they should be incorporated in our estimates of expected return. But well, this is not where we talk about the Black-Litterman model, because that would need a separate video or two. For now, it's bye-bye from my side. Have fun. See you later.